Hey everybody, so today we are going to talk about the employee stock purchase plan. So we'll talk about the basics of how it works, we'll talk about how it's taxed, and then whether it makes sense for you to participate in your ESPP. And then finally, if you do participate, then deciding on when is the best time to sell your stock. Okay, let's get started. As with a lot of things, I figure the easiest way to describe how an ESPP works is through an example. So let's do that. Okay, so let's talk about how to get into your ESPP. So the way that it'll work is you think of it really similarly to your open enrollment for your employee benefits. And so similarly, there'll be an enrollment period that will say, hey, if you want to participate into the ESPP for this offering period, then you have to enroll within this window. And the decision that you make within this enrollment period is how much of your salary that you want to have put aside for the ESPP stock purchase. And so in our example, we have the person here, they work for ABC company, they make $120,000 salary, and then let's say, just for round numbers, that they are electing to enroll and put 10% of their income into the ESPP. So then once you've made that election during the enrollment period, then there's going to be an offering date. So that's going to be the start of whenever the actual ESPP is in effect. And the way that it gets funded is that once the offering date starts, then with every paycheck that you get paid, then your company will pay you, but they'll also withhold an amount, and they're going to basically put it into an escrow account, into a cash account. And so the most common window, the length of a window that the offering is and to the purchase date is 6 months. And so in our example, then in this 6-month period, 10% will put $6,000 into your escrow account. So then at the end of the 6-month period, whenever you get to this purchase date, that is whenever they use this $6,000 to purchase stock into the company. And while on the surface that may not seem like a big deal, the two things that make this something to look at, that make it worthwhile, is the possibility of a discount and then also a look-back provision. All right, so first from a discount perspective, what that is saying is that rather than buying the stock at $15 a share, then instead you can buy it at a discount of up to 15%. So in our example, we're just going to say that it's a 15% discount. And so rather than buying it at $15 a share, then you can buy it for $12.50 a share. The other possible benefit is the idea of a look-back provision. And so what the look-back provision is saying is rather than just looking at the price of the stock on the purchase date, it is also going to look back to the stock price on the offering date too. And so if you would combine those two benefits, then the way that this would work is that on this purchase date, it's going to compare these two, and it's going to figure out what the lower one is, and it's going to use that as the purchase price, and then also add in that 15% discount. And so in this particular example, on the purchase date, rather than buying it for $15 a share, you can actually get it for $8.50 a share. So using the example numbers here, whenever we have set aside $6,000 and we are buying the stock at $8.50 a share, but it's actually worth $15 a share, then immediately on this purchase date, then we've already have more than a $4,500 gain. So now that we've illustrated the immediate benefits of an ESPP, the next thing to talk about is the way that it's taxed once you purchase it. So let's get into that. So I know this picture can look really crazy, but we're going to walk through it. So first, just to show that this wavy line here, this is just illustrating the way that things are taxed depending on what the stock price does, right? So first, if on the purchase date, if you just decide to sell right away, then the difference between what you actually purchased it at and then the value of that stock, that's going to get taxed as ordinary income. So, and then as you go along, the way that it works is that your cost basis is this blue line here. And so if it goes down, then you can actually take that short-term loss and it can offset your income. But then if it gains any more, then the amount here gets taxed as short-term capital gains. Similar to if you would just buy stock normally, then once you wait a year after you've bought it, then that's whenever it switches from short-term capital gains to long-term capital gains. So that's what this part is showing here. And then one thing that is specific as a benefit for ESPP plans, for qualified ESPPs, is the idea of the preferential tax treatment if you can not only hold 1 year from the purchase date, but then you also are holding it 2 years from the initial offering date. And what happens at that time is that rather than your basis being this amount of whenever you first purchased it, it will look all the way back to the stock price on the offering date. And so in our example, whenever the stock price has gone up, then you can see that there's a smaller amount that is considered ordinary income, and then there's a larger portion of it that gets taxed at the preferential long-term capital gains rates. The next question to answer is deciding when you should sell. So one of the main things to think about is how much risk you're willing to take, because remember that whenever we've bought it here, then you're owning you're owning stock in the company that also gives you your paycheck. And so there could be that concentration risk that you'd want to think about. So if you would sell immediately, then this becomes income, and honestly, you're locking in that discount and that benefit that you have. But if you want to try to stick it out and get these long-term capital gains rates, then you could do that. And then really the decision on whether to try to hold this 2-year period, one of the main things to think about is how did the stock actually do during your offering period? Because as this illustration shows, in this example, the stock price has gone up a decent amount. And so holding more than that 2-year period, you can see the benefit that it has here in more money being qualifying as long-term capital gains. But in the example of if this would have stayed flat, then really holding more than that 2-year period doesn't have very much of a doesn't really have any added benefit. And then the strange thing actually is if the stock price actually went down from here to here, then holding over that 2-year period will cause this side to be higher, more income than the other side. So you're actually worse off if you would hold for past this 2-year period. All right, I know there's a lot here whenever it comes to the way that qualified ESPP is taxed, but hopefully the visual has helped out. So if you like what you see, please consider subscribing to the YouTube channel. Or if you would like to reach out to me and learn more, then you can go to javawealth.com, and I will talk to you guys later. All right, thanks.